I want to welcome in our guests here for Inside Out. Our own Sean Cruz joining us from the TD Ameritrade newsroom, as well as Dominic Paoloni. He's the CIO and founder and portfolio manager at IPS Strategic Capital. He's joining us from the TD Ameritrade League Conference in Florida. Good morning here, sir. Dominic, let's talk a little broader market. What do you make of the continued softness we're seeing in equities?
Well, bottom line is, I think that we need a bit of a correction. I mean, we've seen this market explode 5.5%, 6% in January. Even if the market drops 10%, we're still only hitting the 200-day moving average. So we could be in for a nice little pullback and still not be the end of this long-term trend we've seen over the last 9 years.
All right, so Dominic, let me get you to expand on that, because this is what we're hearing a lot lately, right? It's the market that has been basically, as our Kevin Hanks put it, a year within a month of posting big moves, even bigger in the tech companies in the first month of 2018. And within that momentum, folks start to get nervous. What to you could potentially be that catalyst? Are we looking at it with some of the hesitance to buy up on earnings?
Well, let's face it. I mean, earnings are hitting records as far as what 24% of companies have reported, and we're showing 81% are beating.
Yeah.
I mean, that's got to be near a record. So, yeah, I mean, let's face it. There's an old saying, as you know, on the market, don't fight the Fed. What are we seeing? We're seeing a market right now where the Fed's rolling off the balance sheet. You've got China says they're going to stop buying our bonds. Who's going to buy the Fed bonds? What's that going to do to the interest rates? When do interest rates start competing with the market? And I think that's the macro view, is that you get interest rates up in that 4.5 level, you got a lot of conservative money that says, you know what, let's take a breather. If I can make 4.5, 500 basis points, basically without having the market risk, that's where you see competing situations. So you've got QE 1, 2, and 3, and then you had stop QE, but the market has exploded. When you start to roll down the balance sheet, which the Fed is now doing, eventually you're basically, are you in bubble territory? And I think that's a question a lot of people have to look at.
All right, Sean, I want to bring you on this conversation. Dominic, I think makes a good point here, which is, when do interest rates start to compete with the equity market? I might add to that, Sean, and say, for investors who've been able to just run to equities, when will anything compete with the equity market? You're basically coming off a level where you've been very comfortable. So, Sean, are we seeing that with earnings when the high valuation companies are still dropping even though they post those record numbers? Is that because investors are now thinking that they might have potential gains on just a sort of solid rate of income with bonds?
Yeah, I think a big thing you want to look at here is that a lot of these valuations, they were almost hitting the picture perfect outlook, and that is everything goes as planned. And I think we're starting to come and meet those expectations. We are seeing some beats, some strong earnings reports, but apparently investors are starting to take a look and say, you know what, this is about as fully valued as I'm really willing to pay up for. Mm-hmm. And they are looking at rates maybe starting to increase, and I think that is going to introduce quite a bit of risk in the economy. I'm watching a lot of where some of these debt walls are building up for these companies, and maybe the high yield ratings, because I think once they start to have to roll that over, they're going to be rolling over debt that they maybe got back when Fed funds was at 25 or 50 basis points, and they're going to be rolling that over into a higher rate environment, and I think that could introduce some risk, and I think that could shake things up a little bit. So that could be the biggest catalyst that I'm watching coming down the pipeline here this year, that I think could kind of shake up markets a little bit.
All right, building up debt walls. I think that's a good point, Sean. We know that there are certain parts of the market more indebted than others. We know that energy's got a solid amount of debt, for example. We know that even if you're looking at some of the credit card companies, they're taking on debt in a different way, which is more risky places as Americans build up their debt. I want to, Dominic, ask you here, if the market does turn south and it moves further on that correction, is there a place where it is stemming from? Is it a valuation pullback in tech, or is it a sort of interest rate play that brings money out of staples and brings money out of utilities and those groups that have kind of been an easy place to sit for protection? What is it that causes that from sort of a sector level?
Well, let's face it, what we've seen is, even when the markets have sort of taken a breather, it's been rotation. We haven't really seen a correlated sell-off, and this is why I think you're seeing things like the VIX and implied correlation so low.
Yep.
So, let's face it, right now, you've got a situation where you've got the popular trade, because I think a lot of serious money tends to go with the popular trade. We sort of have a behavioral bias. So you think about what was popular in 2010, 2012 was sort of tail risk protection.
Yeah.
Now what's popular? ETFs, passive investing, and shortfall. So it's interesting, you've got $2 trillion in the shortfall strategies. If we start seeing the market come down, when does that turn into a feedback loop, if you would?
Okay.
Is short vol sort of that nitroglycerin in the middle of the market that is ready to explode, which could exacerbate a downfall and sort of a correlation among all the sectors?
I think that's an interesting point. There's a few things in there I like, Dominic. Let's talk, Sean, about that VIX element first, because we know that more and more folks have gotten short volatility, right? It's been a trade that's paid. Everybody read that New York Times article, I believe it was, about the target manager who made $1 million plus on shorting volatility. Sean, I wonder though, how does that trade fall apart? Because I've seen mixed sort of assessments of this. One is that, listen, there's a bunch of capital here, and if the VIX pops, then they're going to hurt, and then they're going to create that feedback loop, as Dominic points out. But you've also got the idea that volatility is sort of a mean reverting mechanism. We know that the VIX, after pops, drops. So can you hold on? Can you roll contracts? How does that actually play out in an event of a downturn?
I think Dominic really made a great point about implied correlations being so low.
Yeah.
And I think once you do start to see if you do start to see correlations really start to move up, I think that can really cause a pretty decent spike in the VIX. And if you do have that, it can be very similar to some sort of the short covering phenomena we see when a lot of stocks maybe have a lot of short interest and then they start moving higher. There starts to be that feedback loop. You could see a similar narrative play out, but I think really what you would need to happen first is some sort of a catalyst that doesn't just make investors not want to be in one sector versus another. Mm-hmm. You need a catalyst that makes investors not want to be
just be in stocks overall.
Yes.
Yeah. Dominic, let's talk about that implied correlation. We've been talking about throughout 2017 the jump in dispersion across markets, right? So the same thing that you're talking about on the inverse side. So lower correlation, higher dispersion. What I think was one of the most interesting cases for the bull market's lifespan was that between 2015 and 2016, there were about 280 companies that went through individual bear markets. It was almost like a washout that happened. That kind of rotation from sector to sector that prevented a big correction in the S&P 500. Instead, it just remained flat. What's to stop that from happening again?
Well, we've got a president that's a bit of a protectionist. So what happens, history, does it repeat itself? Well, we remember in the 30s we had that Smoot-Hawley, which was a protectionist. Donald Trump is all about America first. Well, if he starts putting tariffs and we see inflation really kick up, that could be the catalyst. So that could be the one thing. If we start inflation really kick up, I think we could see that correlation really start to kick in.
I see. All right, Sean, let's talk here a little bit macro as we wrap up the conversation, because I think it's an interesting point, which is post State of the Union, you're not seeing a big market strength. Now, for some, it's totally unrelated. For others, they were sort of hoping for words about infrastructure, words about the next sort of quote-unquote Trump bump. So you look at the market, the softness after this, does it speak to the idea that, listen, we can't sort of jawbone, we can only jawbone the market to a certain extent?
Yeah, I think there's a few things coming up that you are going to want to track from maybe the political side of things. One is the NAFTA negotiations. I think that's going to be very important, because I think as those develop, I think people are going to start to take from that and say this is going to be their general approach to trade with anybody around the world. And then let's also not forget we do have the Treasury funding issue that's going to be coming back around next week, and we're going to start seeing all those headlines about Congress trying to get to some sort of a deal to get a budget going. I think you're going to start seeing that pop up next week. So I think just some of these things along the horizon either are just an emerging risk that could develop, or just something investors are on hold to see what happens, exactly what the details look like in some of these plans.
All right, Dominic, wrap it up for us. All this said, sounds like you're thinking that there could be more potential downside on the way. What do you guys do at IPS? Because I know that you're an options-focused strategy here. How do you protect yourself if you see this kind of downturn coming?
Well, number one, IPSAX, we're a long volatility strategy. We hold about 700,000 VEG in our portfolio right now. So yeah, as markets come down and vol spikes, that's a good thing for us. we're always about protection, so I like optionality because option is a pure hedge. A protected put is a pure hedge. If you can figure out how to carry that at a very low carry, then you've got a nice protective strategy. So yeah, I mean, you're talking to an option guy that believes in the best way to hedge risk is with optionality.
All right, there we go. Dominic Paolini, fantastic conversation. He's the CIO, founder, portfolio manager at IPS Strategic Capital, as well as our own Sean Cruz, talking about the lookout below conversation and what might prevent the market from taking that big dive. All right, Dominic, looking forward to chatting with you more down the road, as well as our own Sean Cruz. Good stuff as always.